Hello, welcome to the Capitol Report on NTD Television. I'm Steve Lance. Ahead of a summer travel season, the Biden administration pushing for airlines to cover passengers' expenses for canceled flights. But U.S. carriers say they're already trying their best. NTD's Iris Tao has more from the White House.
As we're going into a busy summer travel season and as the Memorial Day weekend is coming up, the Biden administration is saying that they want to make sure that U.S. passengers, air travelers especially, get a better deal and that they can hold commercial airlines accountable. And specifically, President Biden today announced that his administration will be rolling out a new rule, a new proposal, saying that all the U.S. airlines will now have to compensate passengers with not only just refunds, but also hotels, meals, as well as cash miles if the cancellation or a significant delay of the flight is on the airline's fault. And that proposal, we expect it to be encountering some pushback from the airline industry. But President Biden today saying that it makes sense because of the following reasons. Let's watch.
You deserve to be fully compensated. Your time matters. The impact on your life matters. I know these things may not matter to the very wealthy, but they matter most to middle-class families and people struggling to get the cost in the first place to get in that airline.
And what he announced today is basically in line with what President Biden has been saying all the time about his overall approach to the economy, and that is to hold big corporations accountable and to grow the economy from the bottom up and middle out. And he also adds that it's important because he wants to lower costs for everyday Americans. But as we said before, airline industry is not going to be happy about this because apparently they're going to be paying more for passenger and compensation. So, and a group that represents the biggest U.S. domestic carriers put out a statement on Monday saying that basically they're already trying their best to make sure that all the flights are on time, either departure or arrivals, and that any cancellation or delay is not what they wanted either. And we also see that today basically what Biden put out is also very important, but the White House is defending Biden's decision to talk about this instead of other what some people consider important issues. Let's watch a back and forth in the White House press briefing room.
You know, is the president really focused on today's biggest issues when everyone in here is asking about Title 42, the debt ceiling, mass shooting over the weekend, and we didn't hear the president talk about any of those things?
Regular American families, everyday families, are thinking about Memorial Day weekend. They care about what the president said today.
And on Tuesday, President Biden will be talking with the Mexican president about immigration and, of course, the fentanyl crisis. And that comes right before Title 42 is about to expire this Thursday.
A new mortgage policy taking effect this month. It's been reported that those with good credit will now pay more, while those with bad credit will pay less. NTD's Arian Pazdar spoke earlier with a mortgage expert to learn more about the policy's details.
A new policy for the Federal Housing Finance Agency took effect last week. The new rule brings some changes to mortgage payments, fees, and more. Critics say it punishes people with good credit and those who make large down payments. The agency said in a statement that changes were made to maintain support for purchase borrowers limited by income or wealth and ensure a level playing field for large and small lenders. Financial officers from 27 states wrote a letter to the White House asking President Biden to rescind the new rule. They say this new policy will force homebuyers with good credit to pay more on their mortgage every single month. And how will these new junk fees be used? To subsidize higher risk borrowers by handing out better mortgage rates to people with lower credit ratings who saved less for a down payment.
Overall, these fees don't really change anything for borrowers.
Jeff Ostrowski is a mortgage reporter for Bankrate. He tells me he thinks the rule will only have a limited impact because the amount people pay won't change much. The Federal Housing Finance Agency responded to criticism about the new rule. The agency says it's not people with good credit score who will support lower fees for low-income people. Instead, it's second-time home buyers who will have to pay more to support low-income buyers.
But is that any different than what people have been pointing out, that people who are doing better will pay for those who are not doing as well?
Yeah. I mean, the general consensus here is that yes, there's some cross subsidization, but the costs for home buyers who are paying more are going to be in the range of $10 to $20 a month. The savings for those who are paying less are going to be in a similarly small range. you're not suddenly going to be able to qualify for a home loan if you couldn't before. You're not suddenly going to be priced out of homeownership if you would have been able to afford it before.
However, the state regulators who wrote the letter to Biden say the new rule is punishing middle-class Americans and will cost them millions of dollars. Arian Pastar, NTD News.
And in related financial news, over 600,000 federal student loan borrowers have gotten their debts forgiven since October of 2021. The Department of Education today saying altogether cancellations will total $42 billion. This program applies to government or nonprofit workers such as teachers or police officers who have made 10 years of monthly payments. It's separate from Biden's one-time student loan forgiveness program that's currently held up in the courts. Back to the new rule on mortgage loans, a group of Republican senators are writing a letter to the Federal Housing Finance Agency over it. One of them is Senator Kevin Cramer of North Dakota, and we had a chance to speak with him not too long ago. Senator Kevin Cramer, thank you so much for joining us.
My honor. Thank you for the opportunity.
Senator, you've penned a letter to the director of the FHFA with quite a few of your colleagues. Could you tell us what is going on here?
Well, it's the most nonsensical economic policy I've seen yet, and we've seen a lot of weird ones lately. But what's going on is the Federal Home Finance Agency came up with a new rule that they implemented on May 1st. And what the rule does is it takes people who have a lower credit score and gives them beneficial financial treatment for loans, but pays for it by taking money from people who have a higher credit score. So if you have a credit score of 679 or lower, you get beneficial terms. If you have a credit score of 680 to 780 and have a 15 to 20% down payment on your mortgage, you're going to get extra fees attached to that to the tune of about $30,000 over the life of the loan to subsidize the people with the lower credit rating. It is the most perverse incentive I've seen, well, really since forgiving student loan debt.
It has eerie similarities to socialism and communism, in my opinion.
It's hard to describe it as anything other than socialism or communism. It's actually a textbook definition of socialism.
Indeed. I just want to read an excerpt from your letter and get your response to it. The letter says in part, this will distort the cost of lending in the U.S. housing markets, making the entire system less efficient and costlier for all Americans. How so?
Well, anytime the government steps in and manipulates a market like this, just remember back a few years ago, right, when we had the mortgage crisis that collapsed. We had a similar situation that collapsed the entire economy because you had incentives for people to borrow money that shouldn't probably be borrowing money. Well, that has to be paid for somewhere else. That's being paid for, in this case, by people with good credit. So that creates an obvious inefficiency in the lending process. All of that at a time when we're on the verge perhaps of a banking crisis. Let's hope that doesn't happen. I think we need to do more things to avoid that, to prevent that. We already are in economic crisis. We're on the verge of a recession while we're experiencing inflation. Interest rates have gone up now as of yesterday 10 times in a row. So everything's wrong. And then they throw this on top of it, which is further wrong.
Senator, I know you don't have a crystal ball, but what do you think it will ultimately take to start getting those interest rates down?
Yeah, so it's going to take a long time is what it's going to take. But what has to happen generally, simply speaking, is inflation has to get lower than the interest rate. But inflation is moving very, very slowly downward, and it's still inflation. In other words, we oftentimes measure it compared to inflation the month before, but remember, it's still high. So once it gets below the rate, I think you can stop raising rates. But that's not the same thing as lowering rates. So I think we're going to have to work through some very, very tough months here, and maybe a couple of years before we actually see the rates come back down.
And to your point, this new rule that they're trying to implement, it comes, as you mentioned, at a time of extreme uncertainty between interest rates continue to rise. We're seeing First Republic Bank, the latest bank to collapse. The timing seems a little bit tricky.
Well, it's tricky for sure. It's nonsensical for sure. And I'm not sure what's motivating. I know in an election cycle, presidents like to do things that take other people's money and sort of spread it around. And that's basically what socialism is. But this one has such dire consequences because it can help collapse an economy, and certainly home ownership, which the thing they're trying to fix or the thing they're trying to spread is the dream of home ownership. The very thing they could collapse is the dream of home ownership. Again, much like the mortgage crisis of the mid-2000s, first decade of the 2000s. So it's a very risky venture to say the least. And it's not, when I say risky, I mean it runs a risk of a complete collapse. But on its face, it's already got negative consequences because it disincentivizes people to have a good credit rating. And by the way, credit rating's not necessarily attached to how much money you have. My parents, when I was growing up, they're both deceased now, but they were middle class, lower middle class, worked hard, had good credit rating because they didn't borrow a lot of money, they paid their debts on time, they didn't take on credit card debt, so they'd have a good credit rating. They would literally, in this scenario, be paying or subsidizing people who make 2, 3, 4 times as much money.
It's a great point. A lot of people sacrifice so much to keep
right.
that and have less because of that.
Yeah, so it's a perverse incentive, but the government's good at perverse incentives, but this one's weirder than most.
Senator Kevin Cramer, thank you so much.
My pleasure, thank you.
Thank you for watching the Capitol Report. If you want to see our full broadcast, check us out at epochtv.com.